Hello and welcome to Manchester. Yes, you heard that right. Manchester, not Marbella, despite the sunshine and the glamorous scenes behind us. Peter, we are in the northwest of England today.
We are. It's absolutely beautiful. It's about 25 degrees, sunny, warm. Not what you'd normally expect.
No, so much for the rainy city. Now, why are we here? It's because today is the grand final for the Financial Reporter Awards. Some big gongs for the great and the good of the financial services industry will be handed out this afternoon. And of course, we have got a packed edition of the Rate Stuff for you today. The first ever edition of the Rate Stuff on tour. We've got some big name questions. And remember, we love to get questions from those of you watching along with us because it's your show. We've got some crackers. I'll be putting Peter on the spot. But for now, I'm Jack Izzard.
And I'm Peter Stimson.
Stay tuned for the Rate Stuff. Well, welcome inside our mobile mortgage palace. Now, Peter, first of all, the colour scheme. What are we dealing with here? Is it beige, taupe, camel?
It's kind of an off-green. It's interesting.
Yeah, I quite like it. I mean, I like the whole kind of wood thing. It's kind of got family holiday, North Wales, 1980. I'm having a bit of a nostalgia trip myself.
Yes, it's not something I'll probably be decorating my house in, but it's definitely interesting.
No, but anyway, we're all about the mortgage market here rather than Peter's interior choices. So let's get back to the matter in hand. And of course, the big matter this week is the Bank of England's base rate decision on Thursday. Now, as luck would have it, we're recording this the day before, on Wednesday, the 18th of June. So there is a possibility that everything we say in the next 10 minutes will be rendered completely wrong and irrelevant by events. It wouldn't be the first time that's happened. But actually, Peter, you're almost certain that the bank won't cut rates on Thursday.
Yes, I mean, I think everything we're seeing in terms of market data would suggest that there's probably a snowball's chance in hell that they cut rates tomorrow.
Snowball's chance in hell. Over breakfast, Peter was telling me that he would eat his hat if they cut rates tomorrow. Does that offer still stand?
It still stands. I mean, I don't own a hat, but I'll go and buy one.
Oh, right, okay. The small print. Anyway,
small print.
You've got it on tape now. Anyway, let's go back to the story of the day, which was inflation. So first thing this morning, we had the CPI data come out for May. 3.4% annual inflation. No change from April. And that wasn't really what the market wanted to hear, was it?
It probably wasn't. So if we go back to the previous month, in April, inflation was up. The market was expecting a fall. It got basically the same. So swap rates, which we're putting up now, haven't really reacted. I mean, the good news, if there was any, was that it's not gone up any further. But if you look a bit closer into the data, it's food and household goods which are going up, which is largely imported inflation. So it's slightly out of the control of the Bank of England because it's inflation that's coming from abroad, because obviously we're a big net importer of food and manufactured goods. So it's a little bit worrying that inflation is proven to be a little bit stubborn. So yeah, on that side of things, it's perhaps not good news, but equally it could have been worse, I suppose, in one regard.
On your point about importing inflation, of course, one of the real issues is importing it through oil. And
Yes.
We've seen oil prices absolutely going through the roof this week. On Tuesday, they spiked by 5% in one day to reach the highest level of the year. This is, of course, all down to the instability in the Middle East. That's got to be a big red warning light for inflation, hasn't it?
It's worrying, on inflation and sort of general economic things in general. And it's got the potential, obviously, to get a lot worse, particularly if we're looking at regime change and general instability. Obviously, events could occur in the Straits of Hormuz that cause issues for tankers. And obviously, oil is not just used, for cars and aircraft. It's used in manufacturing for obviously, plastics and a whole host of other things. So, if oil suddenly gets an awful lot more expensive, it pushes through into, manufacturing and has the potential not just to cause inflation, but more of a general economic downturn as well.
Okay, so on the other side of the economic ledger, of course, we've got shrinking GDP, we've got rising unemployment. So all things being equal, the Bank of England would like to cut interest rates at the moment, but clearly that inflationary problem is going to stop it doing that. So let's look ahead. You mentioned swap rates haven't really moved so far this week. What are they telling you about when that next base rate might come?
It's difficult. So you've got, as you mentioned, on the other hand, other pressures which could, push swaps down or push, interest rates down. We've had 10 months of falling employment numbers. So the last set of total employment numbers saw number of people employed in the UK drop by 108,000. We've also had GDP in April drop by minus 0.3. So that's obviously telling you that the UK economy is definitely cooling.
Yeah.
So, on the one hand, the Bank of England is trying to manage inflation. On the other hand, it's trying to manage the general economic outlook.
Yeah.
June is definitely a no, as far as we're seeing it, and the market as a whole is seeing it. August, we're thinking now, is probably a 50-50. We're thinking we get at least one bank base rate cut in 2025. The question is probably when it is. So if it's not August, September. If not September, probably November.
Okay, so that timeline is just getting pushed further and further back by the inflation.
It is.
Okay, we've talked a lot about the big picture and the macroeconomic stuff. Let's bring things down to brass tacks and the front line of the mortgage market. If you're a broker, you've probably noticed that the interest rates available on 2-year and 5-year fixed rate products are now almost identical. And they've been like that for a few months. And that's not really the norm, is it, Peter?
No, it's changed, particularly over the last year or so. Graph we're sticking up now shows you the 2 and 5 year swaps over the last year, so going back to 1st of July. And if you look at the graph, you'll see 2-year around about 450 1st of July, and the 5-year actually below 4%. But what's interesting is both curves have converged. So we've got 2-year and 5-year, both now around 375, bouncing around a little bit because obviously, what we talked about at the beginning, different things happening, particularly around, Mr. Trump and tariffs and stuff like that. But basically looking out, what the market is saying, it sees no difference longer term and shorter term as to where rates go. So whether you take a 2-year or a 5-year, essentially you're going to be paying the same.
Yeah.
So market is basically saying it sees 2 rate cuts in the shorter term, so sort of 2025, one early, probably 2026, and then nothing happening. So rates essentially settling around 3.75%. So, rate cuts occurring and then the market essentially settling around the 3.75% mark.
So we've got that convergence of the 2-year and the 5-year swap rates.
Yes.
But that's now translating into a convergence in the 2-year and 5-year product rates as
Yes.
well. So what does that, this is not just kind of some oddity, it's actually telling us something quite fundamental about what the markets think is coming.
Yes. So, if you look onto kind of the products and what was happening, if you look at, going back a year, it basically said rates are coming down, the market is obviously expecting and anticipating rate cuts. So you'd naturally kind of expect probably more products to be sold on a 2-year basis, on the basis that, once you sold some on a 2-year, in 2 years' time, rates were going to be lower because obviously the curve was going to be gently down, but you could see where the 5-year was going. When you get towards the bottom of a rate curve, you'd naturally expect more products to be sold onto a longer term product, be that a 3-year or a 5-year, because obviously you're getting towards the bottom of the curve and you'd probably expect to fix there on the basis that rates are kind of bottoming out. What we've seen when we kind of look at ESIS data is back in the sort of July, round about that time, more stuff was actually being sold on a 5-year, possibly because the rate was slightly lower. And now if you look, more stuff is actually being sold on a 2-year. Now, the reason possibly because of that is whether customers or whether some brokers think rates are actually going to continue to fall and go lower, or whether there's just a kind of a general expectation that people prefer 2-year over 5-year. We're not entirely sure. The only thing I would caution brokers and indeed customers is there's a lot of uncertainty out there, as we covered at the beginning, and as you can see from some of the sort of the bouncing around on the curve, do not expect rates to just continually to keep falling, and this expectation that rates sort of go somewhere back to where they were post 2022. It's not going to be this continual drop downwards. There is going to be a settling of rates, potentially somewhere around 375, 350. That is where rates are probably going to end up settling. We've got stubborn inflation. We've got lots of issues in the global economy. Have a think about, when you're having these conversations with clients about what they really want to be thinking about, where they want to settle.
So you've actually just answered the question I was going to ask, which is, if people are assuming that rates will keep falling and they're going to keep going down towards levels we saw pre-Liz Truss, well, think again, that's probably not going to happen. Is that what you're saying?
Yes, I think that's certainly the case. The markets are certainly not assuming that. And everything we're seeing around, inflation and global events would tell me that's not going to happen.
Okay, so that's the consumer side of it. Now, might there be reasons on the broker side? If a broker is looking at a 5-year fix, 2-year fix, basically the same product interest rate, might there be a temptation to go for a 2-year rather than a 5? Because if they do a 2-year, the client's going to come back and need another mortgage in 2 years' time rather than waiting another 5 years.
There's obviously that temptation, but we obviously speak to brokers on a fairly regular basis, and we speak to people at different levels. The conversations I've been having is there's still, I think, with quite a lot of brokers, this expectation or thought that rates are going to be lower in 6 months, 12 months, 24 months. So personally, I think it's an expectation that rates are just going to continue to fall. So yeah, I can understand where that comes from, but personally, I think it's more of an expectation that rates are just on this continual downward trend.
Now, one of the things that we enjoy most on the rate stuff is when viewers send us questions. And we've got an absolute cracker today from Dan. And Dan is here somewhere. In fact, oh, there he is. Dan! 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 It's Dan, everyone. It's Dan Bates from the online mortgage service. He does exist, and he has got an absolutely cracking question. Dan, it's about first-time buyers.
First-time buyers, yeah. So I work with first-time buyers on a day-to-day basis, and what I've found is a lot of first-time buyers that come to me underestimate what their capability of lending actually is. So I believe the media downplaying the market and the mortgage market has a big part to play in this. So when we actually dig into the figures of what they can achieve, it's a lot more achievable than what most people would perceive. Do you think if the media were more positive about the housing market and mortgages, do you think more people would take the steps forward to buy their first property?
Dan, don't look at me. This is one for Peter. It's an absolutely brilliant question.
Thank you.
Peter, over to you.
I think it does a bit. I mean, there's no getting away from it. It is very hard as a first-time buyer to get on the ladder. I mean, some data out there, which I'm sure a lot of brokers have seen. If you go back to 2000, I think the median income needed to buy a house was something like 3 times. It's now just over 7 times. But having said all of that, the situation has actually improved in the last 2 or 3 years. Wages have gone up, house price inflation has stagnated. And actually, if a first-time buyer goes and sees a good broker, they can find ways and means to help them get onto the property ladder. There's 100% mortgages come out, there's joint borrower sole proprietor, there's lots of income, multiple extensions you can get with different lenders. There's lots of different ways that brokers can assist first-time buyers and sort of explain to them different ways that they can get onto the housing ladder, and talk them through what on the face of it appears a very challenging prospect, and actually explain to them actually it's probably not as difficult as you think it is. And a lot of the press coverage has been quite negative, when actually the situation in the last 2 and 3 years has actually got better for first-time buyers. And we've seen that in the stats.
Yeah, well, one thing you mentioned last week, actually, which I thought was very striking, was the fact that the lending criteria have been relaxed, and that is disproportionately favouring first-time buyers in terms of the amount they can borrow.
It is. So, you look what's happened on affordability. We've obviously had several cuts to bank base rate in the last year, which has gone through on affordability. Lenders have reduced their stress rate calculations, which is meaning that in the last year alone, the amount someone can borrow has gone up by around about 20%. A lot of lenders will lend more, particularly to first-time buyers. So if you're going to get a stretch above 4.5 times LTI, it's often favoured towards first-time buyers. So there's lots of things that favour first-time buyers, and a good broker will explain to first-time buyers a lot of the process around buying a house and why it's not as as daunting as you perhaps think.
Okay, Peter, that's interesting. So a nice positive note to end on. And who'd have thought it? The media being overly negative and blowing things out of all proportion. That's never happened before, now has it? Look, nice to have you with us today at the Financial Reporter Awards here. It's been a real pleasure to be talking to Peter and answering Dan's question. Bear in mind, of course, if you've got a question for Peter, you can get in touch via our socials. We always enjoy your feedback. Make sure you give us a like, a follow and a subscribe. We really appreciate it. It enables us to keep bringing you the show. Stay tuned, because we're going to have some lovely bonus content that we're recording today in Manchester, which will be dripping out over the next week or two. I've been Jack Izzard.
I've been Peter Stimson.
And you have been watching The Rate Stuff.